Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks, types of stocks that could potentially go up hundreds or even thousands of percent over time. Today we are talking about SoFi, or Social Financial. SOFI is the ticker of the stock. Ripped higher today on some interesting news. Let's dive right in so that way you can understand what was the news that drove it higher, as well as my current thoughts on the valuation. What's the sort of the upside potential that investors might be playing for as they look at this. So let's dive right in. Here's the disclaimer that you can read on your own time. And so for full context, you can check my channel. I've done a couple of videos on SoFi. I previously called it out around $23 a share and how I thought the valuation might be right to lock in some gains. Since then, they reported their second quarter 21 results. The stock dropped about 40% to its low and then started to recover subsequently. And today, the stock ripped higher, about 13-14% higher, on the news that Morgan Stanley is initiating coverage, saying effectively like, hey, there's two catalysts here that could boost the stocks in the month ahead. So this is, it's always interesting to me to see this sort of song and dance that happens. I personally used to work on the sell side, so I recognize oftentimes they don't actually have any sort of inside take. It's really just regurgitating the news that investors just really either they weren't thinking about it, or it's repeating the news and sort of saying, hey, this is really important. This can change the story. So it's not like an inside take. It's just like, hey, we've looked at it and it looks compelling. So this, resharing that there's these two upcoming catalysts. Let's pound the table on that folks should need to know about, and I'll talk about those catalysts in a second, as well as putting out a price target that's well above the current share price. That really gets folks' interest. They put a $25 share price, which even after the SoFi stock jumped today, it still represents about 40% upside from here, the $25 share price. So let's understand what these catalysts are that Morgan Stanley was talking about. And so looking at it, it really comes down to two key catalysts, one of which is that SoFi has applied to try to get a bank charter. This should happen. Arguably, it could happen any potential month from now, and this really does change their business model. One of the core aspects of this business, the vast majority of their business comes from their lending book, which is primarily sort of a gain on sale of their loans to let's say other financial players out there. So it's all about originating then selling them. Having a bank charter fundamentally changes this business model because you get a lower cost of capital, increases your potential income from holding those loans, your net income margin. It enables effectively them to grow their loan book even faster because they'll have the balance sheet and they'll have this deposit base that they can grow over time. And honestly, it fits really well with their approach of becoming a super app. So that's catalyst number one. Catalyst number two is the fact that you've had U.S. government sort of involvement that's directly impacted their business. When the U.S. government ends student loan deferment on January 31st, 2022, so the start of next year, starting February next year, they can dramatically reaccelerate SoFi's bread and butter, which is the student loan refi business. Now, keep in mind, they've been able to put up really strong growth because they've found other ways to do it, such as personal loans. But it's, this could really help their growth, next year. And so when you think about it, just a quick recap of SoFi, you really are looking at three different business models. One sort of B2B, where Galileo's enabling other financial platforms. You have their lending business, which is, I'd argue, their most important business right now. It's also their most profitable business, as well as financial services, which they're really leaning into, growing at hyperspeed, just trying to create this financial service is sort of the backstop of creating this sort of, I'd argue, super app that covers everything you need, whether or not it's a deposit account, whether or not it's investing, whether or not it's credit card, every sort of thing they're trying to cover under that financial services umbrella. Yet they're using their lending business sort of to fund it for now, because the lending business is where their real contribution profits are coming from at this point. And arguably, if you want to squint and look at the details, so this is their lending product. Lending products business is about 70% plus of their adjusted net revenue, and a key contributor of their profitability with about 50% contribution margins. Now that's before significant, like SG&A or core operating costs, but still, you could see it's not only key size, but it's also the profitable one, because you look at, effectively lending products at $170 million in net revenue for the second quarter versus $45 million for their technology platform, thinking Galileo, and their financial services around $17 million. Now, financial services has just gone crazy, $17 million versus around $2 million last year. So that's the point of really hyper growth there. Now, what about valuation? Here it is. I'm going to do a quick plug. This is your first time tuning in. My name is Daniel. You're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers, please make a point of hitting that subscribe button, hit that thumbs up button. If you want to follow my personal journey, what am I personally doing? First week of the month, I call it my full portfolio. By the end of the month, I call out a potential multi-bagger. Go to unrivaledinvesting.com. Click join the journey. I'm also interacting with the Unrivaled Nation on a daily basis, oftentimes doing quick recaps of these videos in our exclusive Discord server. And so in order to think about the valuation for SoFi, one should understand they're crushing it. Like the number of folks that are using SoFi, that are on their platform, they call it members. I think of it as customers. 2.6 million, up 113% year over year. This is fantastic growth. They are taking share. So while my first inclination is to say, you know what, this is a crowded space. You got a lot of players out there that want to compete. The reality is they're doing really well. They're doing some sort of special sauce that is rapidly capturing customers. And they're growing their top line year to date over 100% year to date, which means that their guidance of about 60% revenue growth for this year could be very conservative. We'll see how it plays out. And so you should be asking yourself, well, wait a second, like they are rapidly taking share. Why are they taking share? Well, they're taking share from the legacy banks that just aren't adapting, aren't, figuring out a way to appeal to everyone, just aren't comfortable playing the game of saying, hey, we'll operate at losses to scale as much as possible. And they've talked about, said, hey, 30% of our profits we're going to, effectively post to the bottom line, but the other 70% we're going to reinvest into growing, compounding at really high rates for years to come. And so the reason why I think they're winning is really this combination of mobile first, convenient, trying to have this super app that's really appealing where you don't have to go to a whole bunch of different services to get your financial business done. If you have a home loan, if you have student loan financing, you want to, start investing in the stock market, you have savings accounts, all these different things can be addressed under the SoFi umbrella, and they're trying to figure out a way to make it super convenient and appealing to their users. And so I think at the end of the day, they're just building a better mousetrap. At least that's what it seems like so far. I'm very curious to see ultimately how does this pencil out to the numbers, and that's what we're going to talk about right now as we look at their financials. And so looking at sort of how I pencil out on the sort of back of the envelope, how do I think about the risk reward? Currently around $18. It's up a little bit from the bottom. It's down from when I effectively said, hey, this might be a little bit rich. Now I think it's important to hey, let's update these figures for their second quarter numbers, which should be included when we're thinking about this. And so I'm saying, look, they're penciling out 58% growth in their top line for 2021. I'm saying, look, that might be conservative given that they're growing over 100% year to date. Might not be. So I'm giving a range of, let's say, 60 to 80% growth, this next year, and then thinking about what do they compound out over the next 5 years? What sort of a range in which they can grow? And what sort of a range in which they can ultimately achieve high operating margins? What could their margins look like long term? And this is, sort of thinking, okay, you're talking about contribution profit from certain segments of, let's say, 30% from their financial platform, from their technology platform. Their financial services still unprofitable, but, maybe 30% contribution margins from their Galileo type platform. And then you're looking at their lending business, which is closer to 50% contribution profits. Now, those need to be sort of adjusted lower to think about, okay, you're going to have fixed costs to run this business and marketing and all sorts of things to, reflect on this business. And so I'm using a range of 25 to 35% margins long-term for this business. And I'd absolutely love for all the SoFi bulls and bears out there, leave a comment below on what you think their margins could look like longer term. Clearly, they're looking to get a lot of scale in the future, and they're nowhere near these margins. So in this analysis, this is sort of the hypothetical, what's the upside potential, doing a low and high range of what could the upside be, sort of laying out these different figures, the low upside and the high upside. That's how I'm trying to think about this. The reason why I say this sort of an upside analysis is because you could always have a business where just things start blowing up and things just stop working right. So this is sort of saying, hey, these are different paths if things work out. And so looking at 60 to 80% growth this year, 25 to 35% profit margins that this business gets valued at longer term, then underlying top line growth or business growth of about 30 to 40% annualized over the next 5 years. Now that's very, very high. Maybe folks start thinking that could be even higher once student loan book starts reaccelerating, that refi book starts reaccelerating in the first quarter, the end of the first quarter next year. That's a question mark. But as I look at this and I think about, okay, you're looking at a company that could be growing for years on end. You're looking at, potentially very lucrative margins, potentially nowhere near that now. Maybe slap on a 20 to 30 times multiple 5 years from now. Once again, love to hear your thoughts on that. Then you're effectively saying, hey, nearly 200% upside over the next 5 years, and maybe downside of about 20% over the next 5 years. So overall, I like what I'm seeing. This is asymmetric risk reward, what I'm looking at it, at least from a high side perspective. This does not remove catastrophic risk. The catastrophic risk means, hey, this could be much lower. I'm not focusing on that here. This is more like, hey, what are investors sort of playing for when you think about this in terms of a range of reasonable assumptions? And that's what I try to do with this framework. And of course, the stock price can go way higher, way lower. I'm just trying to understand what's a rational framework for what investors are playing for. So I could argue, there is that attractive potential of up to 200% over the next 5 years, if they execute on 40% annualized growth in the years ahead. Now that's no small feat, but given the fact that they're rapidly taking share from the market, growing the number of members by 100% plus, can they continue to do that in the years ahead? I think I'm looking at this and I'm thinking to myself, wow, this company's really executing. They're really starting to deliver. I want to see more profit margin improvement. I honestly just sort of want to follow the story some more. I'd love to see how they sort of execute throughout a full market cycle. Currently their business model is going to change a lot. Currently it's this business model that's dependent on sort of gain on the origination of their loans. So they make these loans and then they sell it to other parties for a markup. And what's that business model? What's that business model look like in a potential downturn? So that's sort of a question mark, because I always like to sort of stress test my investments. And also, you could sort of flip that and say, well, wait a second, isn't going to be even better because the profit margin profile for this could look better with that bank charter? And so, anywho, that's my take. I think looking at this, penciling out these sorts of, upside range does make me think I need to sharpen my pencil. So I'd love to hear your thoughts in the comments if you feel like I'm missing anything or any sort of key risks. It's definitely going to be on my radar for something I want to think more about now that they've put up their second quarter figures. Certainly very, very interesting. If this video has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up button. Thanks so much for watching.